your phones are muted just for audio quality control, but your questions are very much welcome. There is a chat box, a question box for you to submit any questions. We will have a live Q&A directly following the presentation. So you submit those and we'll cover those after we wrap up the presentation. Also wanted to let you know that the webinar is being recorded. So a link to this recording will be emailed out to everyone on the line. Whatever email address that you registered with, we will send that link to the recording. So at this time, I'll now turn things over to Ryan Barron. He's our Vice President of Product Development, and he will kick things off. Thanks, Ryan.
Thanks, Tiffany, and thanks everyone for joining us this morning. As Tiffany mentioned, my name is Ryan Barron. I am an actuary, and I lead our product development team at Athene. So I work closely with our marketing team anytime we're bringing a new product solution to market, but also just on an ongoing basis to generate content that helps people work with our products. So we're excited to offer a webinar today that explores some of our recent work in detail. Some of you may have seen our sales brochure and report that focus on diversification and the efficient frontier that we released recently. This session will focus on that analysis and provide some additional insight on how we approached it. This is really a great follow-up to our February launch of 2 new indices within our products. This content in particular highlights the power of our full index lineup and how diversification can be an important tool within a fixed index annuity. And particularly given all the recent market volatility, we feel like it's of paramount importance to understand the tools that are available in our products to manage risk. So to kick us off, I wanted to start with an overview of how we approach selecting the indices that we offer in our products. This is a very disciplined process, and there are several key dimensions that we consider as we go through this process. The first is the intellectual property behind the index. So that's certainly the key starting point, and it must be an idea that we believe in. We really focus on making sure that there are sound academic principles underlying the construction of an index. And overall, take a step back, we have a strong track record of success with alternative indices at Athene. So we feel like we get the opportunity to see some of the best ideas in the market with respect to intellectual property that comes through. Second dimension is diversification. This ties directly to the overall theme of the webinar, and we'll explore it in detail as we go through the presentation, but just wanted to offer a couple of thoughts here. First and foremost, we want the index options in our products to be complementary. We don't need indices that are designed to perform in similar environments or have similar exposures. We want to offer a logical set of choices to our customers in a straightforward framework when they look at the full lineup of indices in our products. The next dimension is the terms with our partner. So onboarding an index into our products involves a negotiation with the partner that we've decided to work with. A lot of times this is an investment bank. We want to deliver strong volumes in terms of the amount of money that goes into crediting strategies that are tied to a given index. And on the flip side of that, we want the deal to reflect the long-term commitments that we've made to our policyholders, and we want our index partner to reflect that as well. So with both of these things in mind, we work through this negotiation to get the best pricing that we can on the options that we buy to hedge our index credits. And what this means is that the better the pricing we get on our options, the more value that we can deliver to our customers in the form of the caps and participation rates that we offer on our products. And then the last dimension that I wanted to touch on is support from our partners. It's not just about having a strong index. It's also important for our partners to support value-add activities that are critical in the sales process. And for anyone that has attended one of the standalone index webinars that we've done over the last 3 months with our partners from HSBC, Bank of America, or BNP has seen this in action with the way that our partners contribute to the value add process. The next thing that I wanted to do is provide some summary points in terms of where we see the strength of alternative indices within our products. We believe strongly in the value that alternative indices provide, and that's why we put so much energy into incorporating them into our products. And there are considerations both from a customer and a carrier standpoint in terms of why alternative indices are appealing. From a consumer standpoint, the first element is choice. So for a long time, indexed annuities offered S&P 500 as the only index option. Now, alternative indices have expanded that universe of choices dramatically and allowed for more customization within the products. The second point is diversification opportunities. Again, that's our theme, our overall theme of today's session. But by allocating their funds to multiple indices that are designed to perform in different environments, we can increase the chance that our customers have strong outcomes over time when they buy our products. And then the last consideration on the customer side that we wanted to hit on is growth potential. The volatility control mechanism that is pervasive across alternative indices allows carriers to offer uncapped crediting strategies, which really, depending on the market environment, they can deliver larger interest credits than a traditional point-to-point capped structure. On the carrier side, the key points to highlight, the first one is differentiation. So a lot of these alternative indices, and we'll talk about the specific indices in our products on the next slide, are proprietary or exclusive to a given carrier. So it allows you to offer something that nobody else offers. Second is stable hedging costs. So again, the options that we buy to hedge our index credits, the more stable the prices are over time, the easier it is to manage a block of indexed annuities. And again, the volatility control nature of alternative indices contributes to stabilizing hedging costs. And the last one, consistent performance. First and foremost, we love to see strong outcomes for our policyholders in terms of the interest credits that they get, but also the company's financial performance is helped when account value performance is strong. So this is a place where incentives are aligned, and it's a win-win when we see strong performance of an index. This slide lays out our index lineup that we offer in our national FIA products. There are 5 index options, and the lineup is really curated to be complementary and with diversification in mind. Again, I mentioned this previously. There's no point in offering multiple options that all perform in the same environment. That dimension of choice wouldn't be valuable or useful for our customers. So when you think about the 5 options that are laid out here, it's a combination of 2 more traditional options with the S&P 500 and then a risk control version of the S&P 500. Those are the boxes at the top of the slide, and then the bottom row, so to speak, the other 3 are all bespoke volatility controlled indices that are exclusive to Athene. 2 of them, the AI-powered U.S. equity index and the NASDAQ FC index, have innovations in how they provide equity exposure, and then the BNP MAD5 index is a multi-asset index that has a global scope. So again, we feel that these are very complementary index options, and we feel it's important to think about the lineup of indices in aggregate. So with that foundation in mind, now we'll turn to the quantitative side of demonstrating the power of diversification. The first graphic here comes from the diversification brochure that I mentioned at the beginning of the presentation, and it's a classic Callan chart view. The way it's constructed is by taking our Performance Elite 7 product, current product rates in terms of caps and participation rates, and then going back historically and determining what the interest credit would have been each year based on how each index performed. And then in each year, the indices are ranked in descending order, so the strongest performing at the top and the lowest performance at the bottom, and then color-coded so you can keep track of them over time. And the headline conclusion from this graphic is that there's no single index that has the best performance in every year. In fact, there are only a couple times where the same index has the best performance in 2 consecutive years. So if you think about buying an indexed annuity and then each year or each index term trying to predict which index is going to have the best performance, the historical data shows that that's very hard to do. So this provides some tangible evidence that diversification is worthwhile, because if you have a diversified exposure across these indices, then it's very likely that you're going to have some exposure to the best performing index in each year. This next slide shows another graphic that's pulled out of that diversification brochure, and it kind of analyzes the crediting strategies one by one, both in terms of performance and in terms of risk. You have the lineup of crediting strategies, and then the far right-hand column is the average return over a 14-year period from 2005 to 2009. And then the second column second from the right is the probability of a 0% credit in that historical data. And it's measured over the length of the crediting term. So for 1-year strategies, it's over a 1-year period, and for 2-year strategies, it's over a 2-year period. So you can see here that if you put all your money in an individual index, then the historical data suggests that there's potentially a meaningful probability of getting a 0% credit. And that's an outcome that a lot of customers would like to avoid when they buy an index annuity. So on the following slides here, we'll show how diversification can help manage a client's expected risk and return profile within our products. And the framework that we used to do this analysis is based on efficient frontier theory. So to provide a little bit of background on efficient frontier theory, this is based on the academic research of Harry Markowitz. He originally wrote a paper in the 1950s that put this idea out there. It didn't really gain that much traction at that time, but then ultimately he was awarded a Nobel Prize in 1990 for this research. So there's evidence that he was ahead of his time when he first brought this out. And standing here today, this is really a hallmark of how people think about managing investment portfolios, and he's kind of considered the father of modern portfolio theory. So it starts with the academic research of Harry Markowitz, and then the way that we put it to use, the key goal is really to illustrate the value of diversification across indices in our products. And the efficient frontier theory says that the most efficient way to invest is to attempt to create a portfolio of assets that has the maximum expected return at a given level of risk. And the other implication of this framework is that diversification can actually increase expected returns and decrease risk when you invest in assets that aren't perfectly correlated with one another. This idea of optimizing the expected return per unit of risk is really perfect for a fixed index annuity, because the option budget that we spend to hedge our index credits really represents the amount of risk that we can sort of put to work, so to speak, for the policyholder. So when we go out and buy options and set our caps and participation rates accordingly, we're trying to optimize the way that we spend that unit of risk. And a lot of people think about diversification in terms of diversification across assets in an investment portfolio, but what we want to demonstrate here is that it can also apply within an indexed annuity. And it really all does link back to the power of alternative indices, some of those themes that I identified previously. And at the end of the presentation, we'll point to some of the marketing materials that we've produced that explore these concepts. So I'll walk through the analytical framework on the next few slides here in terms of how we constructed this efficient frontier analysis. Again, using historical data on all of the indices that we offer in our products, we essentially created a set of portfolios and then calculated the index credits that they would have provided historically, again, using today's caps and participation rates. And from a practical standpoint, the goal in doing this is essentially to create as many portfolios as you could possibly think of. What that resulted in here is 44,108 portfolios with varying allocations to the different indices that we offer, and different strategies that we offer in our products. And then when you have this set of 44,108 portfolios, you can graph the outcomes associated with them on this graph. And the way the graph is constructed is that each circle on the graph represents one of those portfolios. And then the x-axis, or the horizontal axis of the graph, is the standard deviation, or the amount of variation over time in the returns for a given portfolio. And that, you can think of that as measuring the amount of risk associated with a portfolio. Then the vertical axis shows the expected return on an annualized basis for each portfolio. When you create that scatter plot, then that allows you to assess what the efficient frontier might look like. And it was really cool when we produced this analysis that this graph essentially lines up very closely with what you would see in a finance textbook when you looked at what an efficient frontier is. It looks like from a conceptual standpoint. And then when you consider this full graph of portfolios, the dark blue circles are the portfolios that are on the efficient frontier. And what that means is that those are the portfolios that have the highest expected return at each level of risk. So, take a 2% standard deviation, for example. The blue dot associated with that is the portfolio that has the highest expected return at a 2% standard deviation. And any of the dots that are below that dark blue circle have a lower expected return at the same level of risk. And so they don't constitute the part of the efficient frontier. So that's step one. That's sort of the raw output of this analysis. Another useful way to look at it is to consider how a 100% allocation to each index strategy in our products compares to the efficient frontier portfolios. So this graph takes the same backdrop of all 44,000 portfolios and then identifies which points correspond to 100% allocations to the individual strategies. There's a few interesting observations that can be seen when looking at this graph. The first one is that no index by itself is on the efficient frontier. So each, all of those dots fall below that, sort of that top curve. And then a couple other things that are interesting. The 2-year version of the AI-powered U.S. equity index does fall at that top right corner. But you can also, if you move to the left, you can decrease risk and achieve similar levels of expected return if you diversify across indices. And the other thing I wanted to point out is that the S&P 500 is the bottom left corner of the graph. It has the lowest standard deviation of any of the individual indices, so the lowest risk, but it also has the lowest expected return associated with it. And a big part of that is because it's a capped strategy, and the maximum index credit is capped. So the key conclusion from all of this is that in order to get onto the efficient frontier, you need to diversify across index strategies. So there's a lot of interesting analysis that can be done on the full output from that efficient frontier exercise. But we also wanted to make sure that we could turn it into something practical that people can use when thinking about allocation decisions for our products. And so we created these 3 sample portfolio allocations that are informed by the efficient frontier analysis. So I'll talk a little bit about how each one is comprised and what some of the key differentiating factors are. The first one, the conservative portfolio, sample portfolio, is all 1-year strategies. 1-year strategies are generally going to be less risky than 2-year strategies because they have a 0% floor that applies every year. But because of that, they also have lower upside potential in form of the caps and participation rates that they offer. So the conservative allocation here is all 1-year strategies, and then there's a significant allocation to the S&P 500 at 40%. When you move to moderate, you introduce a 2-year strategy with the BNP MAD 5, and then you have more of your allocation in alternative indices. And then the aggressive sample portfolio is all 2-year strategies, and 60% of it is in the equity-focused alternative indices through the AI-powered U.S. equity index and the NASDAQ FC index. And these are not meant to be one size fits all, or to suggest that these are the only 3 allocation models that should be considered. But again, we think that it's a helpful reference point for thinking about diversification and understanding the strategy options that are available in the products. This slide provides one more lens to illustrate the benefits of diversification. And it starts by showing what those sample portfolios, same sample portfolios that were shown on the prior slide. And here we compare them to a traditional FIA strategy that we're characterizing as just 100% allocation to S&P 500 1-year point to point. So with that reference point, we can again see the benefits of diversification. So when you move into these sample portfolios, these diversified portfolios, you have higher expected returns. And then when you think about the efficient frontier graphs that we were looking at previously, you're essentially moving up the curve, so to speak. So again, at a given level of risk, you are set up with higher potential returns because of the diversified exposure across index options. So to kind of summarize what we've covered here today, and then before we provide a view of some of the marketing pieces and then take any questions, I just wanted to summarize some of the key conclusions that I hope you'll take away from the presentation. The first one is thinking about understanding the power of a thoughtfully constructed index lineup. Again, we really focus on making sure that the index choices are complementary and that they're meaningful and that they add value to our customers versus what traditional FIA designs have offered historically. And then the second key takeaway is the power of diversification. And for all the reasons that we've discussed in terms of how you can help manage a risk-return profile through diversification, it also is a way to leverage the power of that index lineup and help position a product to deliver hopefully the best outcomes over time. So with that, I'll talk a little bit about the marketing content that we have available to help leverage these ideas. The first piece highlighted on the slide here is that we have standalone index brochures and fact sheets for each of the indices, particularly the alternative indices that are offered on our products. So those are useful references for doing a little bit of a deep dive into the design of each individual index. Then we have a guide to indices that takes that and puts it all in one place in a good summary view so you can understand what the full lineup of index options looks like. And then the two pieces that I've alluded to a couple times about diversification and the efficient frontier. The first one, called Unleash the Power of Diversification, is a brochure that has several of the graphics that we looked at in the earlier slides. And then the report is a more detailed write-up of this efficient frontier analysis and how we constructed it and shows some of those efficient frontier graphs and provides some of the same commentary that we went into today. So those are all very useful tools, and hope that you all can find value in using them to discuss with your clients. With that, I will flip through the Q&A and try to address the questions that have come in here. I'm just trying to get the window to cooperate here. All right, I've got.
Hey Ryan, I'm happy to read questions if you need them.
Yep, sorry Tiffany, I was just trying to get the size of the window to cooperate with me. All right, so there was a question about the Agility 10 product. This, again, a lot of the ideas here are applicable across our full product set. We focused on the Performance Elite product to do our analysis, and that's the product rates that you saw, and the calculations are associated with that. But again, really with the same lineup of index options, the same conceptual ideas apply broadly across our product set. There was a follow-up on the time horizon with respect to the sample portfolios, the conservative, moderate, and aggressive sample portfolios. And again, really there, it's just the point that we want to highlight is that a 1 versus 2 year strategy within an indexed annuity has an impact on the risk return profile. So because a 1 year strategy has a reset every year and a floor of 0%, there's lower risk associated with a 1 year strategy, but there's always a trade-off between downside protection and upside potential. And so that's why 2 year strategies can typically offer higher caps, higher participation rates than 1 year strategies can. And that informed how we set up the sample portfolios. All right, and then there are a couple questions just on the details of the graphics that we showed and the design of some of the individual indices. And again, the session will be recorded, and there'll be a link to review it if you'd like to do so after the fact. And in particular, I'll backtrack to the slide that shows some of the marketing pieces, because virtually all of these ideas are available in these marketing pieces that can be downloaded and ordered for your reference. So that provides the Unleash the Power of Diversification piece, provides the sample portfolios. They also show up in the Efficient Frontier report. And then for specific questions on the individual indices, both the guide to indices and the brochures and fact sheets are very useful resources there. All right, that covers the questions that have come in so far. So I think we will wrap up there. Thank you again, everyone, for sharing some of your time this morning, and hope that you found today's session useful.